2020 was a pretty brutal year, and in this video I'm going to talk about some of the worst performing names. And so as you guys smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And some of you guys are still dropping meows in the chat, and you guys are my favorite people. So if you haven't done it yet, help out with that algorithm and drop a meow in that chat. All right, let's dive into this. So you can see here that this is the list of the worst performing stocks in the S&P 500 throughout 2022 as of December 27th actually. And so, you see me highlight a few of the names. I'm going to talk about these names. I'm not going to talk about the chip makers because I've spoken about the chip makers recently. So in this video, I'll focus on Match.com, Meta, and PayPal. And of course, I recently talked a lot about number 3 on this list, Tesla, and I pissed off some of the Tesla bulls, but hey, I'm just going to call it like I see it. So starting with Match.com, notice the stock is down 70% this year, pretty brutal. And so what's happening with this stock? Well, let's start with what exactly this company does. So some of you guys may be aware, you guys know what Tinder is. So Match.com owns Tinder. They also own their original OG app, Match.com. These are the ones in the US. OkCupid, Plenty of Fish. Yeah, people still use these apps, but they're not the best. I think Hinge is the one that's most popular now. I actually met my wife on Hinge. Hinge was really good. The problem with Hinge is you get too many dates, and so you kind of like have to slow down a little bit on the swiping on that one. And then these two I don't really know about. And in Europe and Asia, obviously I don't use these. Now, the only thing that I would mention is that, on Match.com, sometimes, although a lot of people don't really use this one anymore, or if the people that do use it are older people, sometimes you get like international people on Match.com. That was my experience. People coming from other countries, they'll use this one. But generally, if you want to meet like local people, they're really using Hinge right now if they're looking for long-term relationships, and they're using Tinder if they're looking for short-term relationships. That at least has been my experience. But the point that I'm making here is that between at least these 3 apps, they largely own the market. Now I know Bumble is a thing and people keep saying that Bumble is a great app, blah blah blah. I've used it, it's fine. The problem is that girls don't really like to make the first move, and so that's why more and more of them are moving over to Hinge, because the guy still has to make the first move and they appreciate that. And you can see the dominance of Match.com. You have 16.5 million payers of these apps. I mean, you can use them for free, so that just goes to show how many people are paying for the apps. Now, the problem with the paying of the apps is that they've slowly started making the free tiers worse and worse. And, that might actually cause people to move away from their apps as well, because, there are other ways to meet people. One of the dating apps that are absolutely free that people use is Instagram, believe it or not. They just get into each other's DMs. And so the point that I want to make is like, of the relationships started on a dating site or app, 50% of them have begun on Match.com. And so, it just speaks to how much these guys own the market. And really what it is it's a consumer monopoly with them purchasing the brands that they've purchased. And so, I don't see a lot of change happening, at least in the near term. Like Tinder started 10, maybe 12 years ago. It's still around. Match.com started in 95. It's still around. Plenty of Fish, maybe it's still used. I don't know if people really use that one. And then Hinge, I think, is the one that probably stick around for a longer period of time. So effectively, the turnover from these apps is getting slower and slower. And so there's longevity with these apps. Now, is there perpetual longevity? Like, is there perpetual longevity with the brand of Coke? Obviously, I can't see the longevity for sort of like a dating app into the future as far as I can see for a brand like Coca-Cola or something like that. And so, that's something that you're going to have to struggle with as you value this name out. How far out does a company like this have reasonably positive economic characteristics? I don't know. I struggle with that question, and that's question number 2 on the 4 questions that we ask when we talk about companies. Now, the question you guys might be asking is, why did Match.com decline in 2022? Well, the share price is largely down because the revenue growth rates that we saw in the past 3 years are starting to slow down. This is why time and time again, I always stress being conservative in modeling out revenue growth rates. And, the Tesla investors have learned that the hard way in 2022, but we'll see if their revenue growth rates actually decline. Tesla's revenue growth rates have not declined yet, and so they are having a good 2022, but we'll see how this plays out. Now, you can see that the biggest area of growth where Match.com really relies on for most of their growth into the future, and so this is where most of the valuation value is, the Asia Pacific region is actually declining, or at least it declined in Q3. And so that's very scary because that's the key driver for future growth. And this is what I mean. So here is my model that I have on Match.com, and you guys can access this at that $5 tier. It's right there. It's available. You can get access to all the models. So notice how the Asia Pacific region is really carrying growth at significantly higher rates in the Americas and Europe. And so before I even get into that, I just want to show you that this is the number of payers that they have, and this is the revenue per payer. That's what RPP stands for. And so, you take the number of payers, multiply by the revenue per payer, and that's how you get to the revenue line. So that's how you forecast out revenue for these guys. And notice that the number of payers in the Asia Pacific region has been growing at a large clip, 21% in 2020, 24% in 2021, and the amount of revenue per payer is also growing. And so in 2021, notice that people in the Asia Pacific region were actually paying more per person than the people in America and Europe. So, obviously, if you have your most lucrative customers and the fastest growing customers coming from a region that has almost like a never-ending amount of people and just huge, large populations, is essentially what I'm trying to say, then you could have really, really blue ocean opportunity here. And the point that I want to point out is that, and this is the reason why I never bought into the hype as much as some other people did, is because you got 3 years of really solid growth, which you can see here. But if you go far enough back, notice that, to be honest, revenue really hasn't grown at all over the past 9 years. You got $2.8 billion and you got $2.9 billion. So the question really is, what gives, right? This company isn't actually growing as fast as we think it is. And so when it comes to forecasting out future growth, I expect revenue to actually grow at a much slower clip. And note that revenue can actually go backwards if the economy enters a recession. One easy area to save money if you're out of work is obviously on a dating site. Like, you couldn't even afford, as a guy, you couldn't even afford to take someone on a date anyways if you're out of work. I mean, unless you have some savings. But notice that I'm growing the Americas out at 5%. I'm growing Europe out at 5%. And I think I might be a little bit optimistic on the Asia Pacific region, where I'm growing them out at 7.5%. Now, you can very easily see people growing these out much faster. And then, of course, the revenue per payer, I'm just doing 5% all the way out. So, you are seeing, I would say, a relatively high growth rate in the valuation. And I kind of did that on purpose to show you what the value comes out to be. So you can see that even despite an optimistic valuation, and I'll actually bring that revenue per user down in the model to maybe around 3%, notice that although it is trading under its intrinsic value, it's not significantly or giving you enough of a margin of safety, even at a reasonable multiple. And so the current share price is approximately $40 per share, trading at around 70% of its intrinsic value, but I'm actually going to bring that intrinsic value down a bit. So it might be trading at around 80% of its intrinsic value. And so, under 25, maybe even like under $20 a share is probably where I want to see this name, and it becomes somewhat interesting. But like I said before, the biggest challenge with Match.com is how much longevity do these apps have? Now, the internet, the change of, the churn of change with dating apps is slowing down as these things are starting to mature. But what does that mean over the next 5-10 years? It's hard to tell. It really is. Now, a lot of you guys are new to the channel. You might not know this, but the people who have been watching this channel for quite a bit, anytime I say, look, I want to look at a stock under a certain price, the people who are the OGs of this channel, they're going to be like, okay, then tell us what the cash secured put yields are at that price. And does it make sense? Because just because the stock is not at the price that you want to buy it at doesn't necessarily mean that value investors don't have other tools in their stack that they could use to generate a return on that position. And like I said to you guys, in 2022, I generated the vast majority of my income on types of opportunities where I wanted to buy the stock at a price much lower, and I found that the cash secured put yields were 20%, 25% at prices that were much lower. And of course, the share price never actually came down to the exercise price, but I just got to keep free premium. So it was a nice way to focus on downside risk and make quite a bit of income without actually deploying capital, because although you are technically deploying capital with cash secured puts, because I just moved the cash into a restricted area and so I can't use the cash. You're not actually deploying capital. It's just like a bet that you will buy the stock if it goes under a strike price. And for many names, they just didn't go under the strike price. So here's the cash secured put model that you guys have access to, and there's a link in the description of this video for you guys to get access to it, and it's free to download. I make it free for you guys to download because I'm not necessarily trying to make as much money as possible from this channel. The whole point is to help people build a community and build a legacy. That's really the whole purpose of this. Notice that using a strike price of $30 per share, I just picked $30 per share out of the air, and using a premium of $4 per share, you see that you generate a 12.5% annualized yield. So it's close, but I'd want that a little bit higher. Also, my valuation, $53, that might come down as well. And so, it's not there, but it's not bad. You can generate a 12.5% annualized rate of return, making a bet that if the stock price comes under $30 per share, you'll buy it. And, the current share price is $40 per share. So, of course, it'd have to come down 25% in 2023 in order for you to get exercised on it. So it's a reasonable bet. I just wouldn't want to hold it at $30 per share. But I just wanted to show you what this particular cash secured put looks like. Now, if you guys want to try out other sort of cash secured puts, different dates, whatever, be my guest. Download the cash secured put model and check it out. Let me know what you guys find. Now, the next name that I want to talk about is Meta. Notice, guys, that Meta is down 66% on the year, and it's the 6th worst performing stock in the S&P 500 in 2022. Now, guys, just a reminder, you get access to the worst performing stocks and the best performing stocks, and this is updated daily in the tracker that you guys get access to at that $5 a month level anyways. And so you have access to this. So you can find it and see how it's performing daily. You can see how the stocks are performing weekly, monthly, etc. And of course, for those of you guys who haven't been paying attention, the reason why Meta's share price declined so much is because of the ongoing cash burn as Mark Zuckerberg continues to invest in the metaverse. And, the big problem is that we just haven't seen the fruits of this labor, but I think that comes soon enough. And I actually think that they are making more progress on this than the general public is aware of. But at the same time, I think AR is the step to move into VR. And so I think they should be focusing more on AR, which I do believe they are with the expected release of their sort of AR device that I think they're going to release in 2023. We'll see how that plays out. And so here's the share price performance in 2022. So of course you can see the 66% decline. You had two major dips, right? And so that was really the name of the game with Meta throughout the year. And so, I checked myself in 2021 and I admitted that I was buying into the hype. And so I actually sold Meta in the 300s. And I said that I'll look at it under $200 per share. You know what was funny when I did that though? There was people in the comments, because I said that around here, like February, March area. And there was actually people in my comments that said that Meta going under $200 per share was a pipe dream. Now, I'm not going to show their comments or whatever. You guys can go back into those videos and see it for yourselves. But I think now it's a nightmare for the folks that bought in 2021 that were holding it at around that $300 per share range. And now they're really stuck holding the bag. Now, I didn't see anything that suggested that the share price was going to decline. I'm not saying that I'm a genius at all. In fact, I'd be the first one to admit that I'm probably not that great of an investor anyways. I just, work hard and I just focus on valuations, and that has allowed me to get away from not making mistakes. So I largely just focus on not making mistakes as opposed to making good calls, so to speak. And, the issue that I had with Meta is that as I started reviewing my model and just taking down some of my assumptions and expectations, I realized, hey, you know what? I love the company. I really like Mark Zuckerberg, but I just can't get behind the valuation. And so I brought my valuation down. And when I brought my valuation down, I realized there wasn't a significant margin of safety to the price that I had it at. And so I had a cash secured put on it. I just let the cash secured put expire. And so that was largely it. And luckily, the shares ran up from the time that I was under exposure. And so, they expired without me getting exercise, and I just got to keep the premium. So it was a good, overall, it was a good move. And then I decided not to renew it and, get into the stock once again, either by buying the shares or selling an additional cash secured put. I just said, hey, I'll wait And I subsequently ended up just building up a large cash position, which helped me in 2022, but I'd really like to start deploying a lot of that cash in 2023. I'd like to, deploy quite a bit of the portfolio in 2023 as we see opportunities. And I just want to point out, a lot of people say that the metaverse is the cash burn for Meta, but you guys got to understand that the metaverse isn't the only cash burning area for metaverse. Note the large increases that we have to model for just total expenses, despite the fact that Zuckerberg said that the company will be flat to slightly smaller in 2023. And that is because we will experience the full year impact of people that were hired midway through 2022. And so, this is a little bit of insider baseball a little bit. I do this internally for companies as well, where we hire people mid-year, and so we have to determine what is the full year impact next year for their wages, salaries, benefits, etc., and how does that impact our bottom line, and of course how does that impact net income, etc., or the free cash flow that we would generate as a company. And so I'd be the guy giving the CFO this number, and so you can see that they, despite them expecting $85 to $87 billion in expenses in 2022, when you annualize the full year impact, they're getting to 96 to 101 billion in 2023. And so you got to pay attention to that, and you got to model that into your models. And if you want to sort of see how that's done, you can just take a look at the meta model that I have. Once again, it's just available at that lower tier of the Patreons, and you can see how I modeled that expense out. Now, there's some other items. Let's get into those as well. And just a quick pause before we get into those other items. This is just another reason, Meta being another reason where we're starting to see this level of complexity. And this is why I harp on the fact that you always got to model out these companies if you're thinking about investing in them, because there's always these little nuances that you don't want to miss. And so I think one of the mistakes that a lot of the finance community made on YouTube, at least, is they'll model out the top line revenue, or they'll model out EPS or net income, but they're not taking into account the nuances of all of the figures. And so that's why I say be as granular as you can, focus on the complexity, focus on getting every line. I understand that it takes more time, but your money's at stake, right? Like, I'm at a point now where, an average position could be 6 figures. And so like, that's a lot of money to lose in a short amount of time if I'm not doing the right research. And so as you go beyond 2023, there's another level of complexity here, right? They're telling us how to model expenses beyond 2023. So they're saying we expect the percentage growth rate of 2023 operating expenses to decelerate meaningfully as we curtail non-headcount related expense growth and keep 2023 headcount roughly flat with current levels. Now, I want to explain to you what this means, because I write these, right? I write these for CFOs. And what this is saying is that they expect the percentage growth rate to decelerate, but that doesn't mean that they don't expect the expense to increase on an absolute level. It's just the growth rate that's declining. So once again, take a look at the model and see how I'm growing this out. The other thing is they're providing us with an expectation for COGS. So they're saying, conversely, our growth in cost of revenue is expected to accelerate, driven by infrastructure related expenses and, to a lesser extent, Reality Lab hardware costs, driven by the launch of our next generation of our Consumer Quest headset later next year. So here you actually should, and just giving you an understanding of what this actually means. When they're saying, conversely, our growth in cost of revenue is expected to accelerate, what they're talking about is, once again, the growth rate. So you have to accelerate the rate at which COGS are growing. So, two opposite things that you really have to pay attention to. Now, once again, they do anticipate Reality Labs will continue to lose money in 2023 and will grow significantly year over year. But, when we model Meta, they're not giving us enough information to sort of model this down to the net income level. So we can't really do anything with this anyways, but it's nice that they at least provide it. So the point that I want to make here is that the metaverse cash burn isn't the only cash burn that we have to model. Notice, we got the year over year annualized impact of HR, like human related cost. And you also have an increase in COGS, or an acceleration of the growth rate of COGS into next year. And so these are additional complexities that you have to model in if you want to have a reasonable model for Meta. So now I've talked about all of these costs increasing, but what is sort of like the buy case for Meta? Why would I still even consider purchasing Meta? Well, the first thing is, let's go through those 4 questions. The first thing is, I really understand the business. It's a great place to advertise. The second thing is, I do see longevity in Meta. Maybe not in their legacy Facebook app, but I'm an older millennial. I still use Facebook, believe it or not. But I also use Instagram, and a lot of even Gen Zers use Instagram. And if TikTok ever gets banned, Instagram wins right away. And so I think, Reels is getting monetized more and more. And so I think there's a long runway for Meta. Is there a runway 25, 30 years out? I don't know. But, I was one of the first people using Facebook, and I think it started in 2005. And so we're now getting to 20 years with Facebook. So, that's a long run rate. And, there's a lot of people who are now behind our generation who've just grown up with these things. And so is there going to be another social media network that comes up? Well, we didn't expect TikTok to have the level of growth that it did. And so, yeah, there could be others that come up. And so what you really need is people who are sort of like paying attention to the market and making sure that they have all the utilities and functionalities that these other apps do. And I think Meta has that. And, Zuckerberg is young enough. He understands the market. I will align myself with a guy like Zuckerberg. I think he wins over the long term. And so I do see long-term viability. So that's the second question. The third question is, are the management aligned with the investors? And they really are. They buy back shares. They return capital to shareholders. I would like to see the cash burn decline a little bit, but we'll see how this plays out. They have a use case as to why they're building this stuff out. Fine. All I'm going to do is I'm just going to deduct that metaverse cash burn from the free cash flow generated to the owner, so the owner's earnings, and let's see what the valuation is there. So that's how you address that situation. And then, of course, what does the value that we come up with reflect relative to the intrinsic value? Well, I'm valuing the company at approximately $175 per share, and it's trading at, $112 per share. I can't remember exactly what it was. So, I would love to get it under $100 per share. So, it's still got a little bit ways to go, and we'll take a look at the cash secured puts. But I do want to give you guys an understanding of what the opportunity is, because there's still opportunity here in their legacy business, which a lot of people don't talk about. I'm actually surprised. There are some YouTubers that I really respect that have not touched any of this, which is kind of crazy, because if you're following a stock and you want to talk about the details, this is some of the detail that you'd want to talk about. And so let's get into that. So you can see here, 3 of the primary areas where they're investing into is, of course, number 1, their AI discovery engine that's powering Reels, but it's also powering recommendations in the Facebook app as well. And so I think that's why they say other recommendation experiences. The second area where they're investing is the ads and business messaging platforms. This is very key, because can you imagine, like, through one sort of like Salesforce type channel or like a customer relationship management piece of software, you can sort of like message your customers that interact with Facebook type ads, and all in that one CRM platform. You can use sort of like the Facebook messaging services and talk to them one-on-one. It fully integrates with Salesforce. I think this is very powerful for lead generation. And Facebook or Meta is a great place to do actionable purchasing. Look, there's only 2 types of digital advertising. I mean, there's just 2 types of advertising in general, but you either have brand building or you have transactional. And I think, Reels and advertising on Facebook Marketplace and all that stuff, it creates this sort of like actionable transactional type of advertising, which is of course more valuable. And so if you invest more and more into allowing the businesses to speak directly to the customers, I think you win. And I think that's a winning strategy for them to invest more and more into WhatsApp, into Messenger, etc. And then, of course, the third area is their future vision into the metaverse, which is where their CapEx spend is going. But I think that gets a lot of coverage, and these 2 other areas don't get very much coverage at all. And so once again, I think number 1 and number 2 seem to be increasing engagement. Reels is starting to win. And of course, business messaging is starting to become profitable. And, metaverse is a big question mark, but I do also believe that the AR space will be a big winner. And so their current surge in CapEx is largely due to them building their AI infrastructure, and they would expect CapEx to come down as a percentage of revenue over the long term. Obviously, that should happen. And so the read through for me here is that over the medium term, we have to expect elevated CapEx spend and R&D spend. So once again, when you look at the model, you're going to see me forecasting this out. So once again, another level of complexity, but now you have that level of complexity not just in the P&L where you have that R&D spend, but you also have that level of complexity in the cash flow statement. And so you have to forecast out an elevated amount of CapEx spend or CapEx burn, and part of that will give you higher revenue. So it's not necessarily all CapEx burn, but you'll forecast that revenue growth separately in the P&L on the revenue line. But essentially what I'm saying is another reason why you need to be building out models on these companies if you're looking to invest in them, because there's a lot of moving parts. Companies are not as simple as just forecasting out the bottom line. And, back to this, they're just saying that, when they launch the next generation of their Consumer Quest headset, I think we can all imagine many great use cases. And, the question, however, is will adoption be higher than expected? I think a guy like me is going to be very excited about this headset, but I think I'm going to be alone on an island. I think the price point's going to be high and the use cases are going to be low initially. And so although I think it'll be a good piece of hardware and software combined, I just don't think the uptake will be significant. I think you'll just have early adopters in the business community taking this on, because I would love if I could work remotely and have multiple screens all over. And so I have my laptop and I have the headset on and, I got multiple screens. That'd be really good for traveling. And so, I could be just as productive as I am in the office. It would also be good for editing videos for YouTube, because I generally have a screen with the Premiere Pro app, and then I have other stuff that I'm looking at on the other side, whether I want to incorporate them in and not. So, for productivity reasons, it could work, but for the general population, I don't think it works. And so, I don't think there'll be huge adoption. So there's still a long runway here, which means they're going to continue to take losses over the medium term on this. Now, they do talk about monetization. And so right now they're saying that Reels doesn't monetize at the rate of feed or stories yet. However, notice what they're doing. They're choosing to take a more than 500 million quarterly revenue headwind with the shift to recommending more Reels, but they expect to get to a more neutral pace over the next 10 to sort of like 12 to 18 months. And so, we have a timeline for when we expect the revenue headwind to subside with the switch to Reels. So, effectively what I was saying a couple of months ago when I said just give them time, they will figure out Reels. Well, now it's happening. They finally figured out the challenge on how to turn WhatsApp into a revenue generating platform, and I'm excited for further growth here. And so, I say it here and I really mean it. Don't sleep on revenue growth in the future with the most valuable type of advertising, which is, a direct communication with the consumer that leads to a direct purchase. And so they started with click to messaging ads, which lets businesses run ads on Facebook and Instagram that start a thread on Messenger, WhatsApp, or Instagram Direct, so they can communicate with customers directly. And, this is one of their fastest growing products with a $9 billion annual run rate, and revenue is mostly on click to Messenger today since we started that first, but click to WhatsApp past $1.5 billion run rate, growing more than 80% year over year. And so I think the clear winners click to WhatsApp, because then the companies have the ability to communicate with people using company related phone numbers as well. And so I think that's very meaningful. So you can have different reps going in and out, having conversations with these consumers, trying to close sales using a CRM software. So I just see a lot of value there. So how am I forecasting revenue for Meta? Well, notice that I'm growing it at, a decline in 2022, a slow growth in 2023 because I expect challenges in the ad spend market, but then there's a bit of a surge in 2024. Now, I could be overly optimistic here, and this is why I'm hoping for a large margin of safety, because I might just be optimistic with my 12.5%, but the reason why I'm using 12.5% is because, when the ad spend market turns around, I think there will be a lot of pent-up demand for advertising. Also, I just think that the WhatsApp messaging platform and Reels combined will be a little bit more lucrative for Meta than people are giving credit to it right now. And so I think they could even outperform in the short term. You know, you could have a 20% surge in revenue very easily. We'll see how this plays out. Now, if you want to disagree with me on that, you absolutely could. We'll see how this plays out. And so where am I valuing Meta? Well, you can see I'm using a 17.5 times earnings multiple after that 10-year mark, right? And so because this is an intrinsic value model, it's not a one-year price target model. So guys, just pay attention to that. It's different, right? And so, you know, I'm valuing them at approximately $175 per share. The current share price, a little bit higher than I thought. So it's at $116 per share. So it's trading at 2/3 of its intrinsic value. I would love to see this under $100 per share. And also, I think most people are valuing it around $200 per share. I can see how they're getting there. I'm just getting to a little bit lower than $200 per share. But, you know, for the people that watch this channel, once again, I know what you're going to ask me. You're going to say, well, what does the cash secured put look like at under $100 per share? Well, I got you because I ran the numbers. But once again, you can download that cash secured put model for free and figure out different exercise prices and date combinations for yourselves. So here's the cash secured put model. So obviously you can see Meta, NASDAQ, and then the exercise price is, or the exercise date is January 19, 2024. The strike price is $100. The premium that you get is $13. And so it's an annualized yield of 12.3. And so, you know, it's not bad, but I wouldn't mind if the yield was a bit higher. So I'm not going to do anything with this. I'll wait and see if the yield will get higher if the stock price comes down a bit more. We'll see how this plays out. You know, my sort of feelings change daily on this almost, but you know, I'm noticing that as time is going on, I'm becoming more and more pessimistic or more and more focused on the downside risk, and so I'm deploying less and less capital. But the problem is that, you know, the cash pile is building up in the portfolio, especially as some of these covered calls or cash secured puts are sort of expiring. And so I really want to deploy capital, but I want to deploy capital in the types of situations that is just like inevitable that it'll work out. And so I'm becoming more selective, which is fine. I don't mind holding a ton of cash. It doesn't burn a hole in my pocket, but it's just making me do more and more research as time goes on. And so for those of you guys who are a part of the Patreon, you're going to see me adding more and more models. You know, some companies that are very well known and some companies that are not well known at all. And so I think 2023 will be the year of me doing a lot more research and just making a lot fewer videos. And so the next name that I want to talk about is PayPal. So you can see that they were one of the biggest losers in 2022 as well. And you can see that PayPal was down around 64%. As of, you know, December 27th. Obviously that's changed. And so what's really happening? Well, you can see here that their revenue is actually growing, right? They're raising their EPS guidance. So wouldn't this be good for the stock? Notice net revenues are expected to grow at 8.5% on a spot basis and 10% on a foreign exchange neutral basis. That's what FXN means, which I think is what it means. And they're raising their GAAP EPS guidance to $2.11 to $2.13. And so these guys are raising guidance. Revenue is still growing. Why is the stock down 60%? Well, the point is, and the reason why it's down is that historically PayPal has grown at a pretty fast clip. Notice 18, 19, 15, 17, 20, 18, 15, 20, 18. So, you know, people are expecting, you know, double-digit growth. And so the growth rate that they're expecting to grow at in 2022 is single digits. So obviously people's models have come down. And so really what's happening here is one of those situations where people looked at the historical growth rates and modeled those growth rates out even further, and now we're entering an environment where growth is slowing down. And so of course they're modeling those growth rates down, which of course is bringing the intrinsic value or the share price or what they believe to the share price to come down. Hence the 60% decline in the share price. Once again, it's another reason why I always say, or just another example why I always say, focus on the downside risk. Don't focus on making great investments that are going to surge. Focus just on not making mistakes. PayPal was easy to see. And the reason why I say PayPal was easy to see is because we were on a call earlier this year and we all looked at PayPal together on our monthly call, and we all unanimously decided that there's a lot of downside risk for PayPal because the growth could slow in the year, and you're seeing growth slow. And so how am I modeling out PayPal? Now, first thing I want to note is that I'm not interested in buying PayPal, even if it does come under my intrinsic value price. I just have a model on it. And so revenue growth is expected to slow in 2022, and I'm not giving them credit for a return to high rates of growth going into 2023. So I'm giving them an 8.5% growth rate in 2022, which largely aligns with their guidance. And then I'm actually bringing that down thereafter. And the reason why I'm doing this is because this space is getting more and more competitive. And so I don't know how to think about competition in this space, especially into the long term. And so that's why I'm not an owner of PayPal at any price. And so let's see what this means for the valuation. So you can see that using a terminal multiple of 15 times earnings, I'm valuing the company at around $50 per share. Their current share price is $68 per share. So it's very expensive relative to my valuation. And so it's not cheap, but also this one could be outside my circle of competence. And in a higher inflation world, this might actually be a natural hedge against the currency, which can be a big catalyst for the growth. So I think that might be part of the growth story with PayPal. It makes a lot of sense. It just acts like an exchange, but I don't understand the direction that this is going because it's largely outside of my circle of competence. There's a lot of competitors, and every year there's more and more competitors coming into the space. And so, PayPal's biggest competitive advantage was the fact that they were a first mover, but how much of a competitive advantage will that give them in the next 20 to 25 years? So that's it for the biggest losers of 2022. Now, another company that was a big loser in 2022 was Tesla. And I recently did 2 videos on Tesla. And so if you are interested in reviewing or understanding how I think about Tesla, get to this video right here.